Have you wondered what financial advisors actually think about finances? This is your sneak peek at the conversations within Financial Design Studio. Michelle Smallenberger, the CEO here, will be your host as you go behind the designs.
Welcome back to Behind the Designs. My name is Michelle Smallenberger, the CEO of Financial Design Studio. I'm your host, and this is actually episode 50 of our podcast, which is really fun. We've had a lot of really great conversations and talked with a lot of really insightful guests, and just enjoyed this and hope that you have benefited from this podcast too. Today, we actually wanted to bring back a guest for this episode. So welcome back, Heather Walser, to the mic. Welcome, Heather.
Thank you so much, Michelle. Congratulations on your 50th episode. That's amazing.
Thanks. It goes by so fast. So you don't even realize how quickly you get there. But thank you. It's great to have you. Heather is a shareholder and the lead estate planning attorney at Lavelle Law. So we're excited to hear kind of what we're going to talk about today and hear her knowledge and expertise. The first time we brought Heather onto the podcast was back in episode 25. We talked about how a well-designed estate plan can strengthen family relationships. Regardless of how often we hear this question from all types of clients, can you just refresh our memory, Heather, of kind of like just estate planning, because this is what you do every day. Why is an estate plan, really something that people need to have?
Yeah, of course. So as Michelle said, today we're going to talk a little bit about kind of next level estate planning, kind of like if we're starting with the 101, what we're talking about today is more the 201 or the advanced estate tax planning. That said, though, for everyone, the estate planning 101 is a must. Even if estate tax doesn't even hit your radar, you want to be absolutely sure that there's a plan in place. Just to make sure that your assets pass in the way that you want them to, that there is a plan if you become incapacitated, and above all else, to keep you out of court. As a general rule, having a judge oversee your assets is really not ideal. So those are kind of the estate planning 101. You want to make sure you've got those bases covered.
Yeah. And then we kind of move up to, okay, secondarily, if you find yourself, if your estate is large enough, then you kind of have where you might fall into actually owing tax at your death. So kind of describe now what someone would need to have in place, or kind of the reason, I guess, for this.
Yeah. Well, so zooming out a bit about the federal estate tax, most people probably know about the idea of estate and gift tax. The idea is that if you give away assets, whether that's during your life or at your death, the IRS will tax those assets. And it's separate and distinct from the income tax. I've had many clients ask me about that, saying things like, I've paid income tax on these assets my whole life, and there's still going to potentially be a tax when I die. And yes, unfortunately, that is the bad news. But the IRS gives you an exemption, meaning you can give away either at death or during your life a set amount with no estate tax. So that's what we call the estate and gift tax exemption, or sometimes you'll hear it called the unified credit. So like I said, zooming out, that's sort of how the IRS structures things. You kind of have a tally or an amount that you can give away without it being taxed. And anything above that amount would potentially be subject to gift and estate tax, unless we do some planning.
Yeah. And that's really where, for today's episode, it's kind of, we're trying to point out kind of who are those people, what to do if this is you. And so that's really kind of like Heather said, this second level, kind of this 201. That's what we're going to be talking about today. If you find that, you just even need a refresher kind of on those basic documents and those pieces, we will point to past episodes where we talk about those with Heather. So those will all be in the show notes. But kind of talk us through, I guess, we talk a lot about taxes, the 2017 Tax Cut and Jobs Act, which happened. And, for most people, that affects them on an annual basis for personal income taxes or business taxes. But this also affected estate taxes as well. Kind of take us back and explain what the change was there, when that is going to, sunset, kind of walk us through kind of that big overhaul that happened affecting estate taxes.
Yeah, sure. So like you said, in 2017, the Tax Cuts and Jobs Act passed, and it really was a massive overhaul of the federal tax code. One of the largest overhauls in about 3 decades. So lots of changes were made to business taxes, to, what can be deducted for businesses, the implementation of a flat corporate rate, all of those types of things on the business side. Also, lots of changes for individuals, which people are probably aware of from filing their own income tax returns since that time. It lowered individual tax rates, increased deductions, gave some tax credits, quite some big changes for individuals. From my standpoint, because of what I do, the biggest impact of the 2017 Act was making a change, a massive change, a historic change in the amount of that exemption we just talked about. So prior to 2017, the exemption from estate tax, or the unified credit, however you want to look at it, was generally, so for example, in 2011, it was $5 million. And it had been kind of creeping up just to keep up with inflation, essentially. In 2017, the passage of the act effectively doubled the exemption. So for that first year after the 2017 Act, in 2018, the exemption went up to almost 11.2 million per person. So it was a pretty massive change, and that is a historic high in that exemption from estate tax. So from my perspective, that was the biggest change of the act in 2017.
Yeah. And that just allowed so many people who have larger net worth, have larger estates, to say, oh, now I can pass a lot more on tax-free. So from that estate tax perspective. So I guess now that we've kind of had that, walk us through now that when that is supposed to sunset. So it's been great, but like I think you were kind of sharing before, like everyone said, it's permanent. But you kind of were sharing like it's permanent until it's not, or,
It's permanent for now, I think was one of the quotes that was in the news about it. But yes, when it was passed, part of the negotiation to get it passed was an agreement that it would sunset, meaning that exemption, that massive exemption, would at the end of 2025, which at that time felt like a long time away, very far away. But the agreement was that at the end of 2025, the exemption would sunset and go back to pre-2017 levels, indexed for inflation, though, from 2017 forward. So what that means, breaking it down, what that means for us all now is that at the end of 2025, December 31st, if Congress does not do anything, that exemption will sunset, and the value, we're not totally sure exactly what it would be, because like I was saying, it's going to, in the legislation, it sunsets back to the post 2017 exemption amount, but it's indexed for inflation. So it would be around 7 million per person. So a very significant change. Now, it's like I was saying, they said it was permanent for now. We really can't predict what is going to happen. As we all are more than aware, there's an intervening election between now and then. And I, like many estate planners, have really given up trying to read the tea leaves and predict what Congress is going to do. So we're really kind of just in a limbo until some legislation gets passed or not passed.
hmm Yeah. And so I guess really what kind of this level 201 that we're saying is, initially you have that estate plan where you're saying, this is who I want these funds to go to. And, as long as you have all those pieces in place, your assets pass and you don't have to worry about estate taxes because you're not at this level to where your assets are going to be above currently that 11 million or the 7 million if this does sunset back. However, people that find themselves in this gap, so even someone, you may say 7 or 11 million, I don't have that today, but someone who's at 5 million, someone who's at 4 million, as your assets continue to grow and as things change, you could very easily find yourself in those windows. And so even just kind of thinking ahead and if it's not you today, could it be you in the next few years, in the next 4 years, even thinking ahead. One thing that was really interesting, I think just yesterday, as we do plan updates for clients, every year, probably in the last 5 to 8 years, yesterday was the first time when we made a plan update for a client where we were actually, from the time they had purchased their home just 2 years ago, the value of the home now was actually worth less than what they paid for it. But in the last 5 to 8 years, I mean, real estate has just gone higher and higher and higher, the values of, what people own. And so that's something, like as you've kind of talked about, everything gets included. And so it's remembering, your home, a lot of people, I think, kind of see their home as an asset. They live in it, but it doesn't really appreciate in value much, or we don't think about it very often. We're always updating these kind of, for clients. So when someone tells you a normal reaction is, oh, if I could get that, or yeah, that's what Zillow says. But in reality, housing prices have moved up a lot. So I think it is really interesting as you're thinking about all of your assets combined, that's something you really have to be mindful of. But that was like the first time that we saw kind of a reverse of something that we have seen for so many years in a row. Can you kind of walk us through, Heather, like what gets included? So when we're talking about estate tax, people might say, well, I have this and this, but that's probably not part of this. Walk us through what gets included when we even start talking about estate tax.
Right. It's such an important point. I mean, the short answer is from the IRS's perspective, everything is included, every penny. And that means even if you have, let's say you had a term life insurance policy with no cash value. So with a term policy, you really have no access to it during your life. You can't borrow against it. You can't leverage it. It really just sits there. And then if you die, they write a check. Well, every penny of that death benefit would, absent planning. I mean, certainly there are ways we can plan for that, but important to note, sometimes that surprises people when they say, well, why is that fair? I didn't have access to that money during my life, but every penny counts. Another really important point where we see it come up with some regularity is kind of the inverse of what you were saying about real estate. Business valuations, people who have, privately owned small businesses, the business owner's idea of what that asset might be worth and the IRS's idea of what that asset is worth at death might be two very different numbers. So that's all included. Of course, any retirement accounts, real estate. And again, with things like real estate, exactly what you said, that's sort of like your clients say, well, if I can get that. Well, at the end of the day, what matters to the IRS is what the appraisal says. So, at your death, the value of that asset may be more than you ever anticipated. So the bottom line takeaway is that in terms of calculating your value against whatever the estate tax exemption is, long story short, every penny is included. And so it's so critical to make sure you have a good understanding of, what your assets look like. And in fact, in prepping for this today, I was just looking at some previous IRS stats. And for example, in 2021, the federal estate tax most impacted decedents, people who died with ownership interests in small business or, privately in successful private businesses, because those valuations are often much higher than the business owner ever conceived of from an estate tax perspective.
Yeah. For those business valuations, so kind of just what you see, and I know this isn't like a all encompassing, this is always how it is. But do you find that business owners who are regularly getting business valuations that, where there's metrics that are used as kind of an outside third party valuation? I mean, typically, would it be fair to say that the IRS might accept something like that rather than if you have nothing and they're just saying, no, you made, kind of made up this number out of thin air. We actually think it's worth more. Is any, thought on that?
Yeah, for sure. I mean, those third party, exactly like you said, these third party valuations are pretty genuinely accepted, if they look, reputable. So that is really the best way to kind of build that case for yourself and have a good understanding of what things are worth. And if you have that history of third party outside appraisals, they're pretty solid.
Yeah, no, that makes sense. And I agree that a lot of business owners don't realize what they have. And this kind of comes with some of that planning of, what will happen to you or to the business if something happens to you. And so it's just kind of along those veins of that thinking, always thinking about those things, but now how it relates to estate planning. So that makes sense. I guess so now if we think about one of the things we always want people to be thoughtful of is, yes, we know that these tax changes are in effect now and that they're supposed to sunset. And so I think, the anticipation of dates that come and go and this legislation, I think a lot of times can bring anxiety to people because they don't know, should I do something now? And we'll talk about more of that in detail, but kind of remind us of, was there a time, I guess, when we look back in history where something similar has happened, maybe what happened and kind of leading up to that? Do you want to kind of walk us through anything you can recall?
Yeah, for sure. So talking about earlier when I was saying we really, as a general policy, don't try to read the tea leaves about what Congress is going to do. And in large part, at least for me personally, that has to do with what happened in 2010. So somewhat similar situation. The estate tax itself, not just the exemption, but the estate tax generally, was set to sunset in 2010. And at least I and many other estate planners were saying, oh, that's such a source of revenue for Congress. They're never going to let that happen. And fast forward to that's exactly what happened. They did not act. It was allowed to sunset. And in 2010, there was no estate tax. So, I think many people have heard the story. I think it was George Steinbrenner who happened to die that year. And the estimate was that it saved his family about $500 million in estate tax. So these types of situations have happened in the past. And if we estate planners have learned anything, it's to not try to predict, because really we were all, I felt very certain I remember saying to clients, I would be surprised if this is allowed to sunset. And that's exactly what happened. So this is, it's not a regular thing, but it's not completely uncharted territory for sure.
Mm-hmm. Yeah. I think one of the things that kind of also can bring some comfort, and nothing that we're going to talk at length about, but, this is an election year and, that's 2024, but this doesn't sunset until the end of 2025, but that gives a year to where something can be done. So if there's going to be changes made to this, it could very well sunset and go back, and that might be the result, but there is time also to make changes. So I think, that just gives people something. There's no reason to be anxious about this, but rather, and this is, I think, as we're going to start talking about, is it's really this attitude and this mindset of, okay, so how should I be thinking about this? And it's really, if you find yourself maybe in, okay, I don't have estate planning documents. First, you want to be getting those in place. Secondly, if you're someone who says, I find myself in this window, or I think I'm in this window of assets when I add everything up in my net worth, it's saying, okay, how should I now start this conversation? And I think that's the biggest thing is, yes, we know we have time to wait and see, But at the same time, you want to know what your options are and what you can or can't do, because a lot of these things with estate planning, and we'll talk about a little bit of, okay, how should I be planning? Yes, there's time, but at the same time, I think what happens a lot as people work with you, Heather, is there's a lot of conversations that lead up to what should I do? And now here's what I'm deciding to do. So at first, it's really just gathering that information. I guess maybe talk a little bit about that. If someone finds themselves and they're starting to say, okay, I want to start thinking about this, walk through kind of, I guess, just this initial mindset of how to be thinking about, I have an estate plan, but I've never really planned for this or started gifting assets, or walk us through just kind of that initial mindset, maybe from your perspective of how people should approach this thinking or this type of planning.
Yeah, of course. I mean, step one, like you said, is always just have the documents in place for, even putting aside any kind of tax planning. That's just a kind of a no-brainer, just to make sure that your family and your loved ones are squared away. But from the estate tax planning piece, the really critical first step is getting a true understanding of what your net worth really is and what the actual numbers look like. And I mean, I say that we don't need to get bogged down into the penny detail, because that can be tricky. It's not easy. But at least big round numbers, let's at least get a pretty current valuation of how realistic your numbers are and whether you're someone who is going to be impacted by the estate tax. And this is probably a good point for me to just make a tiny little asterisk on all of this, is that we are talking solely about federal estate tax. Some states have their own separate estate tax, which is generally more restrictive, as a general rule, the ones that have them. Where I sit, where I'm working here in Illinois, we do have our own estate tax, and the exemption there is only $4 million. So I just want to make that little note to say that, yes, we are talking primarily about the federal, but it's worthwhile, certainly depending on where your residence is, to look at potential state estate tax as well. So in this estate tax planning conversation, valuations are very important, and just getting your arms around how much money are we really looking at. So from there, the next step, and the way I guide my clients, is really a balancing act of the benefit versus the burden. And that may mean even just projecting out, okay, here's how much the potential estate tax liability would be. Here's what you're looking at. And here are the options we can employ, the tools we can use to fix that. And from there, it's a question of, okay, if one of the tools we suggest is, let's give some assets away. Let's put some assets, move them downstream to your descendants, or whatever we decide to do. You can sort of balance the burden of giving up your access and your dominion and control over that asset with the potential estate tax savings. So this is not an all or nothing type of planning. It's really just looking at numbers and we're math people in my job. So we're looking at numbers and saying, okay, what are you willing to give up to, help mitigate this estate tax issue? And you can implement the steps. We work very closely with our clients based on their comfort level, based on what they want to accomplish. And the solutions, it's not a one size fits all. It can be very specifically tailored to the client's pain tolerance, so to speak.
Yeah, I think that's one of the tricky places where a lot of people kind of do get hung up, or there's kind of hesitation, because in order to minimize the value of my estate tax for state or federal, so yes, thank you for mentioning that, because some states it's much lower than this federal than we're even talking about, especially here in Illinois as well. That's where it's kind of this balancing of, well, am I going to need all of those assets for the rest of my life? Can I really give these away? So I think there's kind of this hesitation. And that's where I think it's helpful that you kind of say it doesn't have to be an all or nothing. It can even be kind of progressive over time where maybe I start gifting. So I know you've mentioned kind of, hey, in 2024, you could try it and see how that felt, see how that goes. And then in 25, leading up to it. So that's where it's, you can kind of decide and see how you feel about that, little by little. So I think that's really helpful. Yeah. So I guess, what are some of the things, or I guess for people planning, some of the tools? So when we say like what you can do, so for an estate plan, we know we need to have powers of attorney, trust, will, pieces like this. I guess, can you give us kind of like a high level of ways that people are planning, or what you're kind of seeing? Is it mainly just using trust, just different types of trust? I guess just a high level of what people could expect if they start thinking about this. Okay, this is what this means in planning.
Right. I kind of alluded a minute or two ago to the idea of gifting. We sort of generally refer to it as gifting. And where we often see that is really kind of pushing assets downstream to descendants. That's a very common strategy. And it doesn't have to be descendants. It can be, anyone that you wish to benefit. And frequently, an issue that comes up with that question, with that type of gifting or planning, is, as I mentioned before, dominion and control. People really struggle with, I have to give up control of this asset, another piece of the puzzle is that possibly the descendants that you are hoping to benefit, they may not be anywhere near an age or an experience level where they are prepared to deal with a large chunk of money. So that's a very common sort of big picture plan. And one of the ways we implement is by, setting up trusts. We can set up, for example, just irrevocable trusts for each of the descendants. And then we can even add in an intervening level of potentially an LLC or another type of entity. And part of the structure of that is to help the grantor, the person making the gift, to at least have some sort of oversight of the asset. It's not just, here, I'm going to give you this stack of cash and you do with it what you please. That's often a very big, the balancing act, like I said before, of giving up enough dominion and control to satisfy the IRS that, okay, you gave this away, it's no longer in your estate, but you can still have some influence over it. So that's that's a pretty common structure. That's kind of like LLC plus trusts. We have lots of other trust vehicles, SLATs and GRATs. We're lawyers and we love acronyms. And those types of asset management, those types of they're gifting, but it's also this idea, you and I were talking about this earlier, of making a gift of something, of an asset at its present value, with the understanding that most likely it's going to appreciate. And so, with any of those types of trust, the idea is you get it out of your estate at the dollar cost now in today's dollars, but then by the time you pass away, it's probably worth far more. And so you've gotten that appreciation out of your estate, but with certain types of trust, you can still maintain access. You can still live in the home, for example. You can, continue to really sort of possess the asset while still satisfying the IRS that you don't own it anymore. So like I said, so many of these things are just, there's no one size fits all. It's very tailored and very specific and can be graduated. We can start slow. And it's just that balancing of burden versus benefit. I mean, I have some clients who are so driven by keeping that estate tax, out of the equation that because in their mind, it's the balancing is, I'm willing to give up some control because that means this money doesn't end up with the IRS or, the Illinois Department of Revenue, for example.
Yeah, no, I think that's helpful. So it probably even somewhat depends on the types of assets that people own. So if we're talking someone who owns a lot of real estate versus someone that just has a lot of taxable funds that are in investments that are maybe more liquid, I'm sure that kind of even plays into it too, and the use of those assets and what they're going to be needed for in the future. So I could even see that being something that plays into that.
For sure. And, I'm sure you see this as well. There are so many other complications, with retirement accounts, for example. Many of my clients have really developed a large portion of their net worth by being savvy retirement investors. And some 2020 changes in the law have made that a little tricky. Maybe we can do another podcast about that.
Exactly. Yep.
But, so it really is very client and asset specific. You're spot on, right?
Yeah. And I like the idea that you mentioned too, that so estate planning, when we're talking about planning and getting assets out of your estate to, essentially give today. So that is growing out of your estate. Now you're not paying that estate tax on it federally or with the state you live in. Some people, say, I don't want to pay any tax because I want all of these assets to go to the beneficiary. So I want all of this to be passed on. Some people might say, I'm okay if I have to pay estate tax. I just want to be the one to pay it. And then the remainder of the assets go to the beneficiaries. But I think this is even really helpful for people to even see what amounts are we talking about? Because if we start talking about, well, my estate tax is going to be, $500,000 or $1 million, those get to be big dollars where it can become really important to say, I would much rather that go to a charitable organization or to my kids and grandkids rather than that. And so I think even just helping people to see, like, here's the dollar amount that we're talking about. So now that helps people to decide. But yeah, you have people in a couple different camps even on that thought.
Exactly. That's correct.
So I guess kind of with all of like these different estates, valuations, pieces that we've talked about, I guess really our encouragement is for people to start considering these things. And someone who hasn't done anything, I guess, time-wise, when you think about, okay, this is going to sunset in 2025, and let's just say we really don't know what it's going to be like. So a client who really has the basic estate planning documents, hasn't done anything, I guess, leading up to that time-wise, what's your encouragement to them to say, hey, let's be sure that you're starting because this is going to take you, X number of months, or how long do you feel like on average is kind of this process? And I'm sure it depends on the size of the estate as well, but walk somebody through who's kind of just starting the thinking in this process.
Yeah, for sure. I mean, to feel comfortable, I would want at least a year. So really it's not on fire right at this moment in, almost September 2024, but it's getting there. I would say just because there are so many moving pieces to it, if you have to add valuations in, you need to hire a company to do an appraisal, all those types of things can make things take longer. And it's certainly not, I'll tell you, it's not at all uncommon for us and probably many tax advisors out there, probably you as well. That December 31 deadline is sometimes it's midnight, but in an ideal world, if you can start looking at these things now and develop a comprehensive game plan that's not guessing, that has, real good data behind it, it's, as I said, I would say it's not on fire right now, but now is a great time to really think about it. And one other piece of the puzzle is to zoom out a bit on this planning idea is there's not much of a downside from the standpoint of if you do this planning. Let's say that you say, okay, I am going to gift, X amount of dollars down to the next generation because right now my exemption is at an historic high. I'm going to use it. And then Congress acts and they drop the exemption down and you've gifted away more than the exemption. You've won. I mean, you've pushed a substantial amount of assets out of your own estate and onto, charities or the next generation, however you choose to do it. And if the IRS lowers the exemption, like I said, you've won. But the flip side of that is if the exemption stays the same, or even if it goes up, you haven't lost because you've already pushed those assets out of your estate for tax purposes. And really the big issue about those things from a less about the exemption perspective, and this is absolutely your wheelhouse and not mine, but those assets that you've given to the next generation or however you've structured them are, if you do it right, going to continue to grow. So by making those gifts at today's dollar value, even setting aside the issue of the estate tax exemption, if you run that analysis and you say, okay, 20 years from now, those assets are going to be worth, pick a metric, 10 times what they were. That's a win. So it's almost like there's not, the only downside I would say is just that having to jump through the hoops to give up enough control of the asset to satisfy the IRS that you have gifted it.
Mm-hmm. Yeah, that it's actually been a finalized gift that's been made. And that, I think that's where a lot of people kind of get uncomfortable. Okay, I have to do this. So it's completed. And so that means I'm giving up control. And you could, like in some of these instances, but it's very hard to take back control if you even can. And so I think there is just that hesitation. So I know it's like natural for people to feel this hesitation in this planning. And so that's why I think so much conversation and discussion goes into it. Talk a little bit about, just to briefly, we talked about like net worth and knowing what that is. And, I probably should have said this earlier, but just at a very high level, if you're to take everything that you own and you write out its value today and you sell it, and that's what you're left with. So if all of your assets and everything you own add up to $4 million and you owe $1 million, let's say in mortgages, whatever that is, you're left with that 4 million minus the 1 million that you owe, you're left with 3 million. That is your net worth. So when you take everything you own minus everything you owe, that is your net worth. And so when we think about that, like you mentioned, a big part of that can be retirement accounts. Do you want to just touch on like high level kind of what you're seeing there? I know we're seeing a lot of things, whether you name the trust as a beneficiary, whether you don't. So there's just even kind of big pieces like that. Do you want to just touch on kind of what you're seeing in some of those pieces and kind of just anything that people should kind of be aware of? Because if they aren't going to get estate planning, that is going to be something that once you pass away, your beneficiaries are going to have to deal with. Anything that you want to kind of share or touch on there, even at a high level?
Yeah, so I mentioned the Secure Act that took effect in 2020, and that made changes. While we're here talking about the estate tax, for retirement accounts, that made some pretty significant changes on the income tax side. And where that comes up from an inheritance or a death perspective is, yes, you could make gifts of retirement accounts. You could have them pass into trust. You could sort of restrict them to keep them out of the beneficiary's estates. There are lots of things you can do. However, the downside of that is, and this is in large part due to the passage of the Secure Act, is the way that those assets will eventually be subject to income tax once you die and your beneficiaries receive those assets. So quick, 20-second, I guess, overview of that. It used to be that and some of your clients may have even had this situation where they have an inherited IRA that they got from mom or dad or a grandparent, and they're allowed to take RMDs, to take the money out of that retirement account over a time period, maybe over their own lifespan, or maybe over the lifespan of the projected lifespan of the deceased person. And that's the benefit of those retirement accounts is they are allowed to grow and they don't get taxed until they are subject to income tax when you take them out. So we used to have a much longer, we call that a stretch. You could stretch it over time. The Secure Act changed that so that the only people who get the stretch are disabled beneficiaries, that's one, surviving spouse, they can take the stretch, and then minor children. So minor children can take the stretch until they hit the age of majority, which just depends on the state. It might be 18, it might be 26. So that is a pretty significant income tax impact. And if you do not any, but there are some strategies that you could use for sort of gifting or using those assets differently, having them pass into trust, for example, that now post Secure Act can be problematic from an income tax standpoint, because instead of getting that stretch that you had prior to 2020, or that the surviving spouse or a disabled beneficiary still has post 2020, you would have to withdraw the entire retirement account in 10 years, sometimes 5, depending. So that could, with a large investment account, a large retirement account, that could be a very substantial tax hit. So just kind of circling back to, I always say I'll be short 20 seconds, but I'm never short. So, going back to what I was saying before, is that all of this is, we're only as good as the data. And so we just look at the numbers and say, try to project out as best we can, is the income tax hit significant enough that it militates against doing any sort of estate tax planning, or is it not? And again, this is absolutely your wheelhouse, not mine. But, just anecdotally, I have clients who are doing a lot of Roth conversions right now. And I think that might be scheduled to change. I think there are some limitations happening on that, if I'm remembering correctly as well.
Yeah. It's really the timing. So what is so interesting is often we'll say, people will think with investing that timing is everything. So when I own the stock, when I buy it, when I sell it. And so, whatever you believe about that. But what we usually say, because no one knows what's going to happen tomorrow. And so what we usually say is with timing, taxes, timing, that is when timing is everything, because we're really trying to match what's going to happen from your life. So things that are going to happen. If there's a business sale, if there's a real estate sale, something big that might generate capital gains or something like that. We're trying to balance that against the timing of, well, what can we do? Are there opportunities? So as we're talking about gifting, now if we're talking about what assets that's coming from, and if we give that charitably, you can match these things together. So timing them at the same time, where you're neutralizing the taxes that you're going to pay with maybe a larger than normal deduction that you would have. But the way you do that is now, okay, if I'm doing 3 years worth of giving all in 1 year to help against this large capital gain, and now I already have my money set aside for the giving I'm going to do for the next 3 years. It's really trying to pair these things together so that we're timing it to where when you know what's going to happen, and when it actually does, then we can actually do, on the flip side, something that's beneficial to actually help neutralize what's going to happen. And so for what we can and what we know is going to happen, so when we're talking about legislation and, okay, it has a sunset date, these are the types of things, whether it's income tax, estate tax, these pieces together, that's the type of things that people are doing and working toward. What I find is that people, and you can comment on this too, I really think those people who are working with an advisor, so whether that's yourself, Heather, on the estate planning side, a financial advisor, to actually make sure that as these opportunities come up, that the people who are working with someone consistently, so we say all year, every year, this is how we're helping our clients to manage this stuff, is when an opportunity becomes available. Since 2017, we've had these new tax rates. So this is not anything new that we've been talking about, but now we're talking about it because the sunset is happening. And so these are the things that if you were someone who knew about this in 2018 and started taking advantage of these wider brackets with lower rates, you were able to benefit maybe more than someone who has a year remaining. We never, judge anyone for saying, oh, you could have done this. But we just say from today, then let's take advantage of what we can. But I do think people who are starting these conversations, they have an advisor of some type they're working with, that they get to take, advantage of the value that they get, possibly longer and over the whole time that it's available. So this is where I think just encouraging people as you are to start these conversations, start doing something, because people will know if I fall into this bracket or not. And so I think it just helps people to know, okay, this is something I should take action on to start. Is there anything else, I guess, with the IRAs, we've talked about that, anything else that you kind of see estate planning wise in this landscape, anything you're seeing or noticing that you would just kind of encourage people to, act on or do something if they haven't? Anything else you want to add?
Yeah, I mean, I think I just want to piggyback off the point you were just making that it is so helpful to clients to have people helping them based on their knowledge base. So I've said a couple of times, that's not my area. I sort of know enough to be dangerous about some of these investment type ideas, but I'm an estate planner. I'm an estate tax and estate planner. And so clients benefit so greatly from having from having you focusing on the things that you focus on, and, someone like me focusing on what I focus on, and plus their accountant, really a team effort. Because we don't want to do this planning in a vacuum. And I don't want to say that and make it sound like, oh my gosh, this is so complicated. It's so difficult. It's really not. I mean, it's really not. But it's more just as simple as keeping your people in the loop, because an estate tax planning strategy, like we just discussed, could have implications on the income tax side, or your advisor, like, you said, you may be privy to information about, oh, they've got some losses this year. This is a great time to take some income. So that's what's great about it, is that it doesn't need, it's not to say that it's complicated. It's that if you can keep all your people on one page, you can really accomplish the goals that you want to accomplish based on your pain tolerance or your threshold for, burden versus benefit.
Yeah. Yeah. No, that's really helpful. I think this has been helpful just to kind of give us just a reminder that, we may feel like we've been talking about these things for years because it's been around since 2018, but now with the sunset, it just kind of brings up change. I think change can make people anxious, but it's also this reminder of, okay, as long as you have things in place for if something happens, and then once we know if anything's going to change or if they're going to revert back, then again, you can do, like you said, little by little. So I think it's helpful just to encourage people, just, do as you're comfortable, but also be thoughtful and just be sure that you're having these conversations. Anything else you would kind of add just to close us, or?
No, I mean, I think as always, you've done a masterful job. Well done. But I think if nothing else, the biggest takeaway, I think, for clients is this: if you're thinking about this, even if you're listening to this and saying, well, okay, cool, I'm not even at 7 million. It's not going to be a problem for me. Whatever the case, take a look at your estate plan. Even if you're thinking, I don't need the tax planning, it never hurts to look at the documents you have and just make sure everything is doing what it's supposed to, because life circumstances can change quickly or slowly. You just need to double check everything and make sure. And if you're listening to this and it's front of mind, now is a great time to look at it, whether the estate tax implicates you or not.
Yeah. Yeah. No, that's great. Thank you. Yeah, it is interesting with finances. It's one of those things that the longer you wait, things don't get better or easier. It just, there's just potentially opportunities you could be missing or value you could receive by acting sooner and doing it over more years, the span of more years than just all of a sudden when something changes. Yeah. Well, thank you so much, Heather. I think this has been really helpful. With this, we've reached the end of our episode. Heather, thanks for joining us.
It's a pleasure.
If you want to connect with Heather or Lavelle Law, you can do that from the show notes. We're going to put that information there from this episode. You can also find those on our website. Our next upcoming podcasts have some really excellent guests that we're looking forward to, just kind of updating a lot of these pieces as they're happening. We don't want you to miss out on any of these upcoming episodes. So to stay updated with what we're doing, follow Financial Design Studio on Facebook or LinkedIn, where we post snippets and updates of our podcast. And until then, we will see you in the next episode.
Thanks for listening. To find any links or resources related to this episode, check out our show notes. Your host was Michelle Smallenberger, a certified financial planner and CEO. The guests featured are from Financial Design Studio, a team of experienced fiduciary, fee-only advisors based in Chicago. Anna Lewis is the executive producer of the Behind the Designs podcast. And as always, for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. And final note, no content discussed on this podcast should be taken as financial advice. Financial Design Studio accepts no responsibility for your individual choices. We'll see you in the next episode.